Welcome back to the deep dive. There's this lingering idea that accounting is just a necessary evil. It's the department that says no, or the people who file the taxes. But when you actually dig into it, really get into the mechanics, it feels less like admin and, well, more like high-stakes detective work.
It really is. It's an investigation.
Yeah.
You are constantly trying to piece together the reality of a business using, nothing but a trail of numbers. And if you misread one clue, the whole story just falls apart.
And to see just how easy it is to misinterpret those clues, we're looking at a document that is effectively a black box recorder for accounting students. We're doing a deep dive into the ACCA Financial Accounting Examiner's report for September 2024 to August 2025.
This is a fascinating document. It's not a textbook. It's a postmortem. It's the examiners looking at thousands of papers from all over the world and basically saying, here is where the logic broke down.
And the stakes are high here. I mean, we aren't just talking about passing a test. The errors the examiner highlights are the very same ones that in the real world lead to misstated profits, tax audits, or, investors losing their shirts.
Absolutely. The feedback this year was very, very specific. They focused on this inability to distinguish between what the bank says and what the business says, the danger of misinterpreting apparently good ratios, and the absolute chaos that can happen when companies try to combine their accounts.
So let's jump right into that first crime scene, the bank ledger. The examiner discusses Section A, the objective test questions, and flags Example 1 in a report. This involves a company called Ginning.
Right. So the setup seems pretty harmless. Ginning has a bank general ledger, that's their own internal record, showing a debit balance of just $176. It's a tiny amount, but they know there are errors. The mission is to find the true balance.
And this is where the language barrier hits. In the report, the examiner notes that candidates really struggle with the fundamental concept of debits and credits when it comes to the bank. And honestly, I get it. If I open my banking app on my phone and see a credit, I'm happy. That's money in.
That is the mirror image trap.
Yeah.
You have to remember your relationship with the banks. When you deposit money, the bank owes you that money. To them, your account is a liability.
So they credit it.
But you're not the bank. You're the business.
To me, that cash is an asset.
Correct. And in the strict rules of accounting, you increase an asset with a debit. You have to completely flip your brain.
Yeah.
If you don't reverse the logic of your personal bank statement, you're going to get every single entry backward.
So in the example, they have this list of adjustments: rental income, payments to suppliers, all standard stuff. But then there's this one line item that tripped everyone up.
Customer check rejected by the bank.
Yes, that one.
This is a great example of needing to understand the timeline. So imagine what happened first. You get a check for $150. You sit at your desk. You enter it into your ledger. You debit the account because you think, great, I have more money.
Right. In my mind, the cash is mine.
Then the bank tries to process it and it bounces. Maybe the signature's wrong. Maybe the customer's broke. The bank rejects it. So now you have a debit in your books for money you don't actually have. How do you fix that?
Well, the instinct is to just delete the line.
Yes.
Just, pretend it never happened.
In a database, maybe. But in double entry bookkeeping, you generally don't just erase history. You have to post a correction. To remove a debit, you must post a credit. You're effectively recording a payment out to neutralize the fake money that came in.
So you're crediting the ledger, which feels like spending money, but you're actually just admitting you never had it in the first place.
Precisely. And the report says many students missed this. They only got to the final answer, which was a corrected balance of $2,371 if they correctly identified that the rejected check was a credit entry, just like paying a supplier.
That leads us right to the next layer of complexity, which is Example 6, bank reconciliations. This is where I think the logic gets really, really tricky. The examiner gives a scenario where the ledger balance is $22,500 debit. Then they list 4 discrepancies, and the job is to figure out the final reported bank balance.
The core skill here is playing the blame game. You have to look at each discrepancy and ask, is this my mistake or is this just a timing difference?
Let's look at the items. Item 1, bank charges of $2,000 omitted from the general ledger.
That seems straightforward. The bank took fees. I didn't write it down. My bad.
Correct. That's an omission. So you have to update your books. You credit your ledger $2,000 because that money is gone. That changes your internal balance. But then look at item 3. The bank incorrectly credited the business account with $4,000. So the bank made a mistake and gave us $4,000. Now I'm looking at this and thinking, well, the money is in the account. My balance is higher. Shouldn't I record that?
That is the temptation.
Yeah.
But ask yourself, is it your money?
Legally, no, they're going to take it back eventually.
Exactly. So you do not touch your ledger. Your ledger is a record of your actual assets. A bank error is not your asset. It's a phantom. You just note it on the reconciliation statement to say, hey, the bank statement is wrong by $4,000, but you don't adjust your own books.
That requires so much discipline. You're essentially saying, I know the bank statement says X, but I'm refusing to accept it because it's not real.
That's the job. And the same logic applies to unpresented checks. If you wrote a check for $800 to a supplier, you've spent that money. Just because the supplier is lazy and hasn't cashed it yet doesn't mean you still have the funds.
So you leave the ledger alone.
You leave it alone. The money is spent.
So the final adjusted balance in that example, $19,500, only comes out right if you ignore the bank error and ignore the unpresented checks.
It's binary. If you adjust for the wrong thing, you just double count the error.
Okay, let's move away from the microscopic view of the ledger and zoom out to the big picture. Section 2 of the report deals with ratios, and this is where the detective work, turns into interpreting a story.
This is example 2 in the report. It deals with ROCE, return on capital employed. This is the gold standard ratio for investors. It tells you how good the company is at using its cash to generate profit.
And the scenario compares 2 years. In 20X8, the ROCE was 35%. In 20X9, it went up to 40%. On the surface, that looks fantastic, a 5% growth in return.
It looks great. Then you look at asset turnover. It went from 0.88 to 1.20. That means for every dollar of assets, they're generating $1.20 in sales. The company is churning out product. It's faster. It's busier.
So we have higher returns and higher efficiency. Why on earth is the examiner flagging this as a trap?
Because of the third piece of the puzzle, profit margin. You have to remember the relationship. ROCE equals asset turnover multiplied by profit margin. So if ROCE goes up a little, but turnover goes up a lot, the math implies that the margin must have crashed.
Let's run the numbers. So if ROCE is 40% and turnover is 1.3,
you divide 40 by 1.20, the profit margin for 20X9 comes out to 33.3%.
And what was it the year before?
39.8%.
Wow. That is a massive drop. We're talking nearly a 7% slide in margin.
Exactly. So the real narrative isn't this company is thriving. The narrative is this company is the busy fool.
The busy fool.
It's a classic business trap. You slash your prices to get customers in the door. Sales volume explodes. The warehouse is empty. Asset turnover looks amazing.
But you're keeping pennies on the dollar.
Exactly. You're working twice as hard to make the same amount of actual profit. Or less.
That is a huge red flag for an investor. It suggests the demand isn't real. It's just been bought with discounts.
Correct. And the examiner's point is simple. Don't just look at the ROCE and clap. Look at the components. The efficiency was masking a profitability crisis.
I want to touch on the true-false section the examiner mentioned regarding IAS 10 events after the reporting period. This felt like a psychological game.
Oh, this was brutal. Question 3. It listed 4 statements about what happens between the year end and the date the accounts are actually signed.
And usually in a multiple choice question, you expect a mix, 2 true, 2 false, something like that.
Right. But in this case, the examiner notes that many candidates failed because every single statement was true.
That requires so much confidence to actually select, to go, yep, all of them.
It does. It tests if you really know the standard or if you're just guessing based on patterns.
The one that stuck out to me was about non-adjusting events. Can we just clarify that?
Sure. So imagine your financial year ends on December 31st. On January 15th, your main warehouse burns down.
Okay, that's a massive event.
Huge. But on December 31st, the date of the snapshot, the warehouse was standing. So you do not change the numbers in the financial statements. It's a non-adjusting event.
But you can't just hide it.
No, that would be completely misleading. So the true statement is that you must disclose the nature of the event and an estimate of the financial effect in the notes to the accounts. You have to tell the shareholders, here are the numbers for last year, but heads up, we just lost a warehouse.
So transparency without rewriting history.
Exactly.
Okay. Let's get into the heavy hitter. Section 3 covers the multitask questions and specifically consolidated financial statements. This is when a parent company buys a subsidiary. The examiner seemed pretty frustrated here.
Yes. With how students handle the concept of control, this is the #1 conceptual error in group accounting. Let's say parent co buys 60% of subsidiary co.
Okay.
The intuition for a student is to say, well, I own 60%, so I should record 60% of their cash, 60% of their inventory, 60% of their loans. It feels fair.
It feels proportional.
But accounting isn't about proportion. It's about control. If you own 60%, do you control 60% of the warehouse?
Yeah, you control the whole thing.
You control the whole warehouse. You hire the manager who runs it. Therefore, the accounting standard says you must bring in 100% of the assets and liabilities line by line.
That makes sense. You're the captain of the entire ship, even if you don't own every single plank of wood in it.
Correct. We deal with the part you don't own later. That's the non-controlling interest, or NCI. But for the assets, you take it all.
So let's walk through the math of goodwill from example 4. This was Theta Co. acquiring Iota Co. Goodwill is basically the premium you pay over the sticker price, right?
Yes. It's the value of the brand, the reputation, the synergy. But calculating it requires a strict process. You need 3 numbers. First, how much do we pay? This is the purchase consideration.
And in the example, Theta paid in 2 ways: cash and shares.
Right. They paid $500,000 in cold hard cash.
Yep.
But they also issued $400,000 of their own shares. Now, you have to value those shares at their market price on the day of the deal, which was $2.40.
Okay, so 400,000 shares times $2.40. That's $960,000, plus the $500K cash. That puts the total price tag at $1.46 million.
Step 2, we have to add the value of the part we didn't buy, the NCI. The question gives this to us as a fair value, $120,000.
Right.
So the total pot of value is the $1.46 million plus that $120,000, which gives us $1.58 million.
Now, step 3, we subtract what we actually got, the net assets of Iota Co.
And here is the trap. You can't just look at Iota's balance sheet. Their books show share capital of $800 and earnings of $410. But books are historical. They are old news. We need the value today.
And the report mentions a fair value adjustment on land.
Right. Iota had land on the books for $200,000, but the real market value is $250,000.
Correct.
As the buyer, you are paying for the real value, so you have to increase the net assets by that $50,000 difference.
So if we take the total net assets adjusted to include that extra land value, it comes to $1,260,000.
Now you do the final subtraction. The total pot, $1.58 million, minus the net assets, $1.26 million. You're left with $320,000.
And that $320,000 is the goodwill. It sits on the balance sheet as an intangible asset.
Exactly. But if you missed that land adjustment, your goodwill is wrong. If you miscalculated the share price, wrong again. It's a cascade of errors.
There was one other warning in the consolidation section that I really liked, the intergroup cleanup. The examiner talks about eliminating unrealized profit.
This is the one entity concept. Imagine you and your spouse have a joint bank account.
Okay.
If you sell your car to your spouse for $5,000 and the money moves from the joint account back into the joint account,
right,
has the household made a profit?
No. The car is still in the driveway. The money is in the same pot.
Exactly. But in business, individual companies record these sales. Company A sells to Company B. Company A records a profit. But if they're in the same group, that profit is fake. It's unrealized. The inventory hasn't actually left the family.
So the examiner is saying you have to strip that out.
You have to be ruthless. You eliminate the sale, you eliminate the purchase, and most importantly, you reduce the value of the closing inventory to remove that fake profit. If you don't, you are essentially lying to your shareholders.
By inflating your assets with value you created out of thin air?
Just moving inventory from the left pocket to the right pocket and charging yourself a fee? It happens more than you'd think.
We have time for one last technical point, the statement of cash flows. The report mentions the indirect method causing headaches, specifically with disposals.
This is another one of those logic flips. The indirect method starts with your profit from the P&L and tries to work backwards to get to cash.
Okay.
Now, if you sold a van during the year, you probably calculated a profit on disposal. Let's say you made a $2,000 accounting profit on that van. That $2,000 is sitting in your total profit figure.
Right.
But is that $2,000 cash generated from operations? Did you earn it by selling your product? No. It's a one-off sale of old equipment.
So it's in the wrong bucket.
Correct. So in the operating activities section, you have to subtract that profit. You strip it out.
But we did get cash for the van. Where does that go?
The actual cash received, the check the buyer wrote you, that goes into investing activities. And the examiner notes that students constantly mix this up. They double count it, or they leave the profit in operations. You have to separate the accounting profit, which you remove, from the physical cash, which you report elsewhere.
One final detail the examiner begs students to notice: the titles, as at versus for the year.
It sounds so trivial, but it shows if you understand what the report even is. The statement of financial position is as at. It's a snapshot of midnight on the last day of the year. The profit or loss is for the year ended. It's a video of the last 12 months.
Calling a balance sheet for the year is just sloppy.
It's imprecise. And accounting is the language of precision.
So we've covered bank ledgers, the busy fool ratio trap, the mechanics of goodwill, and the ethics of intragroup trading. If you had to summarize the examiner's main message this year, what would it be?
The message is, don't just learn the method, learn the logic. You can memorize that a debit goes here and a credit goes there, but as soon as the examiner gives you a rejected check or a warehouse fire, memorization fails. You have to understand why the money moves, and you have to study the whole syllabus. These systems are all connected.
That idea of unrealized profit really stuck with me. The idea that a group cannot profit by selling to itself.
It's a fundamental truth.
It makes me wonder about other areas, outside of accounting. In business strategy or even just personal productivity, how often do we create fake value just by moving things around?
That's a deep question,
We reshuffle the to-do list and feel productive. A company reorganizes its departments, they bill each other for internal services, and they think they're generating growth, but the car is still in the driveway.
We mistake activity for value.
Exactly. The examiner says eliminate unrealized profit. Maybe that's the takeaway for the week. Look at your work, look at your business, and ask, am I generating real external value, or am I just moving inventory from the left pocket to the right?
And if you are, don't book it as a profit.
A harsh but necessary lesson. That's it for this deep dive into the ACCA Examiner's Report. Thanks for helping us decode the traps.
My pleasure.
See you in the next one.